How South Africa's financial system traps the consumer is the sixth video in the series. Why South Africa is becoming poorer. South Africa is one of the most unequal countries in the world. According to the World Bank, the country has the highest Gini coefficient of inequality, meaning the gap between the wealthy few and the struggling majority is vast. At the heart of this inequality lies not only historical injustices, but also the modern financial system, banks, credit providers, and debt mechanisms that keep millions of South Africans in a cycle of poverty. Credit, loans, debt review, blacklisting, and high service fees are marketed as tools of empowerment, yet in practice, they often serve as chains of financial bondage. What is designed to help people access opportunities ends up enslaving them to interest rates, fine print, and financial institutions that value profit over people. This essay explores how financial institutions exploit consumers through fees and interest, how financial products hide harmful conditions in the fine print, how penalties like blacklisting and debt review flags deepen poverty, and how legislation itself contributes to entrenching inequality. 1. How financial institutions exploit consumers. South African consumers live in one of the most expensive credit environments in the world. While the South African Reserve Bank sets the repo rate, currently 8.25% in 2025, lenders are legally allowed to charge prime plus several percentage points depending on risk. Microloans, store credit, and payday lending often carry effective interest rates of 20% to 40% annually, sometimes higher when service fees and insurance are added. For example, the National Credit Act allows initiation fees and monthly service charges on loans regardless of loan size. This means even the smallest short-term loans can become disproportionately expensive. Retail credit, furniture, clothing, appliances, often includes mandatory insurance products that inflate the real cost of the goods. A couch advertised at 5,000 Rand may end up costing 9,000 Rand after interest and hidden add-ons. Banks charge overdraft facility fees, account maintenance fees, and ATM withdrawal charges that hit hardest on low-income earners. Instead of enabling upward mobility, these financial products often consume more than 30 to 50% of a household's disposable income in repayments, locking families into debt cycles that leave little for food, education, or healthcare. The National Credit Act was introduced in 2007 to protect consumers from reckless lending, but in practice, the complexity of financial agreements ensures that consumers rarely understand what they are signing. Insurance add-ons. Many loans and retail credit agreements require credit life insurance, which is automatically deducted. Consumers often do not realize they are paying for it, and in many cases, claims are rejected due to fine print exclusions. Medical aid. While marketed as essential, schemes have waiting periods, exclusions, and co-payments that trap low-income consumers. A family may pay thousands per month, only to be denied coverage for critical care when needed. Banking contracts, terms around penalty fees, overdraft interest, or early settlement are buried in dense documents. Ordinary South Africans, many with limited financial literacy, are left at the mercy of systems designed to be opaque. The fine print becomes a weapon against the poor, ensuring that financial institutions collect maximum profit while consumers absorb maximum risk. South Africa's credit bureau system ensures that financial mistakes follow consumers for years, long after the crisis that caused the missed payment has passed. Blacklisting. A consumer who defaults on even a small store account can be flagged at credit bureaus, damaging their profile for up to 5 years. This prevents access to new credit, housing rentals, or even jobs, as some employers check credit scores. Instead of offering rehabilitation, the system imposes long-term exclusion. Debt review. Marketed as a lifeline, debt review is often a trap. Once under review, consumers cannot access any new credit or financial products. In practice, this isolates them financially. While it protects them from legal action, it also means they are locked out of the economy for years. Many exit debt review poorer than when they entered, still unable to access housing finance or business loans. Default judgments. Courts allow creditors to attach salaries, cars and even homes. Garnishee orders, emolument attachment orders, can reduce a worker's pay by up to a third, pushing families deeper into poverty. Instead of rehabilitation, the system enforces punishment and exclusion, which entrenches poverty and prevents upward mobility. At its core, the South African financial system reflects a paradox. It markets credit as empowerment, but uses debt as control, debt as enslavement. Families borrow to pay for school fees, food, transport, or funerals. With each loan, they hand over more of their future income to financial institutions. As interest accumulates, the borrowed freedom becomes lifelong bondage. Systemic poverty. According to Statistics South Africa, over 70% of South African households are indebted, with consumer debt-to-income ratios often exceeding 72%. In such conditions, poverty is not accidental. It is engineered by a system that profits from keeping people in perpetual repayment. Legislative entrapment. While the National Credit Act aimed to curb reckless lending, loopholes allow institutions to continue high-fee practices. Debt review was designed as relief, but functions as exclusion. Credit bureaus enforce long-term blacklisting, creating a permanent underclass of financially disqualified citizens. The psychological burden. Debt is not only financial, it is emotional and social. Families collapse under the weight of repayment stress, children inherit a mindset of scarcity, and communities fracture under the strain of poverty. South Africa's financial systems, banks, credit providers, insurance schemes and legislative frameworks have created a paradoxical form of modern slavery. Debt, credit scoring, blacklisting and debt review isolate citizens from opportunity and trap them in cycles of repayment that benefit only the institutions. And all the while these institutions harass the public, including those they have relegated to poverty, daily, with their SMS, inviting you to apply for loans. If these words moved you, don't keep them to yourself. Share this story. Leave your thoughts in the comments. Follow for more wisdom, because together we can build a better South Africa.